Every second, thousands of transactions cycle through the global fast food ecosystem. In 2023, the McDonald system alone generated $129 billion in sales. That represents the total amount of money customers spent at every location globally. But the parent corporation only collected a fraction of that. Their actual corporate revenue was $26.8 billion. This $100 billion gap exists because the most successful restaurant giants no longer focus on the day-to-day business of selling food. These organizations act as intellectual property and real estate holding companies that use food service as a vehicle for collecting fees. This structural shift focuses on moving assets and liabilities off the corporate books. The strategy revolves around a specific 60% rule. This is a threshold where the majority of corporate revenue comes from franchise fees, rent, and licensing, rather than restaurant operations. Once a company crosses this line, it is largely protected from the daily volatility of labor costs, inventory spoilage, and store maintenance. To reach this state, corporations sell their own stores to independent franchisees, transferring the operational risk to those external partners. The modern QSR balance sheet is a financial framework built to capture high-margin revenue while maintaining minimal capital exposure. This chart breaks down the 2025 revenue for McDonald's into three segments: company-operated sales, franchise royalties and rent, and other revenues. The company-operated segment represents the stores the corporation still runs directly, bringing in $9.69 billion. In 2025, revenue from these corporate stores fell by 1% as foot traffic fluctuated and operating costs rose. Now look at the franchise royalties and rent segment. This tier brought in $13.93 billion, making up the bulk of the company's income. Even as corporate store revenue shrank, this franchise tier grew by 5% during the same fiscal period. This divergence creates what analysts call a margin cushion. The difference in profitability is extreme. Direct operations yield about a 16% gross margin, while franchise revenue yields 82%. Because corporate revenue is calculated on top-line franchisee sales, the parent company is not impacted by rising labor or ingredient costs at the restaurant level. Here, owning the restaurant is a financial burden. Owning the entire system is the ultimate goal. Corporations extract this value even when franchise royalties are capped at 5%. They achieve this through the real estate layer, a strategy McDonald's uses to act as a commercial landlord. First, the corporation owns the land and building, charging the franchisee a mandatory base rent. Then they add variable rent, which increases as the franchisee's sales grow. This dual rent structure functions as a hidden second royalty that the corporation collects on top of its standard fees. This real estate model ensures that cash flow remains stable, even if individual restaurant operators struggle with their profit margins. By controlling the property, the corporation captures the upside of a successful location while maintaining a guaranteed financial floor. Real estate is only one method of extraction.
Restaurant Brands International, or RBI, uses a different approach. RBI is over 99% franchised, but its revenue structure is distinct from that of McDonald's. RBI utilizes a supply chain capture model, which is most visible at Tim Hortons in Canada. The corporation requires franchisees to purchase coffee, ingredients, and equipment directly from the parent company's supply network. This captive supply chain helped drive RBI's total revenues from $7.0 billion to $8.4 billion in 2024. While McDonald's extracts value as a landlord, RBI extracts value as a mandatory supplier. In both cases, the objective is the same: create a recurring, high-margin stream of payments back to the parent company. But beyond the physical restaurants, the newest and fastest-growing tier of this lucrative franchise model is the global digital layer. This chart tracks a specific line item on the McDonald's 2025 income statement called Other Revenues. In one fiscal year, this category spiked by 53%, reaching $647 million. This is digital rent. It consists of fees paid by franchisees to use corporate apps, loyalty programs, and global technology platforms. This is an industry-wide trend. Yum Brands now processes over 300 million annual transactions through its AI-driven tech platform. Corporations are charging their own franchisees a premium to access the data and digital systems they need to operate in the modern market. These technology fees have become a third mandatory tax for franchisees, joining royalties and rent. We can see the end result of this logic by looking at a company that has pushed the asset-light model to its mathematical extreme. Yum Brands, the owner of KFC, Taco Bell, and Pizza Hut, operates a massive multi-brand network. 98% of their 61,000 global units are owned and operated by franchisees, not the corporation. Franchise fees and mandatory marketing contributions make up 66.1% of their total revenue. This structure generates enough free cash flow for the company to open a new restaurant every 2 hours using external franchisee capital. Yum Brands has moved away from restaurant operations, functioning instead as a global brand steward and procurement engine. This dot plot shows the competitive landscape and the one vulnerability in this financial system. Notice the gap in performance. Chick-fil-A generates over $8 million per store, while McDonald's averages $4 million. The constraint here is AUV, average unit volume, which measures the total annual sales of a single restaurant location. The parent company can only collect its rent, royalties, and digital taxes if the independent franchisee makes enough money to stay in business. This is why corporate strategy now focuses on drive-through efficiency and AI, not to lower food costs, but to protect the franchisee's volume and the corporate fee. The global quick-service restaurant industry relies on financial engineering to isolate profit from the risks of the kitchen. By controlling intellectual property, real estate, and digital infrastructure while outsourcing operational risk, these corporations have built the ultimate asset-light cash flow machine.